Right. I think we may have a critical mass now watching, so I think maybe it's time to get started. So let me just screen. I hope you can all see my screen. Please let me know if you can't. But yeah. So welcome, ladies and gentlemen, to FNA's first CBDC broadcast, our new monthly webinar covering the latest CBDC news, topics, and developments. My name is Will Towning, and it is my great pleasure to be your host throughout this series. Each month, I'll be sharing the latest CBDC news and developments, and I'll be joined by a guest speaker from a variety of CBDC stakeholders, including commercial banks, FMIs, technology solution providers, central banks, and academia. This month, I am joined by FNA's founder and CEO, Dr. Kimmo Soramäki, and FNA's Director of Advanced Analytics and Simulation, Dr. Carlos León. Kimmo has been working with central banks for over 25 years, starting at the Bank of Finland, where in 1997, he developed the first simulation model for interbank payment systems. He's also held positions at the Federal Reserve Bank of New York and the European Central Bank. This work led him to found FNA in 2013 to solve some of the important issues around financial risk and explore the complex networks, financial networks that play a continually larger role in the world around us. Today, Kimmo will be sharing a brief introduction on payment simulation. We will then pass over to Carlos León, who will be explaining how commercial banks, central banks, and other organizations can use simulation technology to understand the impacts of introducing a CBDC. Carlos León is responsible for leading the development of FNA's CBDC Simulator solutions. Prior to this, he was a senior researcher at the Central Bank of Colombia. In this role, for more than a decade, he was responsible for investigating and developing methodologies for overseeing local market institutions and infrastructures, with a focus on systemic importance, financial networks, and intraday liquidity risk. His prior work experience includes positions as a short-term expert for the IMF and as head of the risk management group at Colombia's Ministry of Finance and Public Credit.
Sorry to cut in, Will. It's tech support here, but are you just checking you're progressing the slides, because we're still looking at the homepage?
I have been. Let me just. Here we go. Here we go. Apologies for that.
Okay, lovely. I'll disappear.
So now, before I cover some of the latest CBDC developments in the news, I have a few housekeeping announcements. If anyone has any questions, please feel free to leave them as a comment in the Q&A section at the bottom of your page, and we'll address them all at the end of the session. Alternatively, if you would like to follow up on any of the discussions in private, then we can, please feel free to visit the FNA website or contact myself or FNA using the details on the slide. We will be providing you all the slides and the recordings of today's sessions in a follow-up tomorrow, so please keep an eye out for that. So, as I'm sure you're all now aware, the introduction of CBDCs is getting closer, and a new era for payments is fast approaching. Today, 87 countries representing close to 90% of global GDP are now exploring a digital currency. This is up from 35 countries in May 2020. 3 countries have now fully launched a digital currency, and 17 countries are in a piloting phase. So this is a global trend spanning some of the biggest economies and some of the smallest, and incorporates both developed and developing markets. But with the impending reforms, there remains many outstanding questions covering topics such as disintermediation, adoption rates, the impact on payments behavior, payment service providers, card companies, financial market infrastructures, as well as the financial stability and monetary policy implications. And this is all the backdrop to which FNA's CBDC broadcast was created, to provide a roundup of the latest news and key developments, whilst also providing a monthly deep dive into specific topics and related solutions. So with that said, if there are no comments or questions at this stage, which I do not see any on my screen, I will start sharing some of the recent highlights in the CBDC space that we thought were interesting and worth raising for a number of reasons. On January 7, China's State Council made a new push to convince consumers to start using the digital yuan. The Cabinet's policy blueprint outlined plans to encourage the use of the digital currency in various scenarios, including retail transactions, utility bills, and administration services. The push follows the digital yuan, or the launch of the digital yuan mobile application by the People's Bank of China. The app now allows users in 10 areas of major cities, Shanghai and Beijing, to start transacting with the digital currency, marking a new step towards the national rollout. Previously, only select users could use the app on an individual basis. China is the largest country now to officially launch a CBDC. Although the rollout is incomplete and China's particularities are obvious, it is a case worth following from close, especially as the Winter Olympics are 3 weeks away and the expectation of a large-scale trial that includes international visitors. In November, the World Bank Group released a decision-making framework to assist central banks and financial authorities to investigate the potential use of CBDCs, steering clear of questions on whether a country should issue a CBDC or what type of CBDC they could issue. The guidance urges authorities to carefully evaluate all of the risks and potential implications of introducing a CBDC, alongside a plan that can prevent and mitigate these risks. The World Bank Group says CBDC should be accompanied by the presence of relevant foundations, such as a sound legal framework, a sound regulatory framework, efficient infrastructures, and a strong commitment of relevant stakeholders. The group urges central banks to consider whether they can count on adequate human and financial resources over the medium and long term to support such a reform. We expect the World Bank and other regional development banks to lead or support efforts by central banks to design and implement CBDCs. Frameworks such as these will be key to understanding how CBDCs will develop around the world. Next slide. Also in November, G&D's Technologies Chief Executive Officer Wolfram Siedermann said the success of a CBDC rests on the understanding of users' needs and concerns. His remarks were made in a November report titled Consumer Attitudes to CBDCs, Considerations for Policymakers. It was written in collaboration with the official Monetary and Financial Institutions Forum. In the report, G&D Technology said that central banks must tackle design questions related to what features are important to users and what barriers would inhibit the adoption of the CBDC. The firm also encourages authorities to consider how consumer behavior may change over time and incorporate flexible core systems to CBDCs. We agree with G&D that motivations to design and implement a CBDC vary across countries and regions. CBDC success will depend on how those motivations are fulfilled, as some efforts to roll out a digital currency demonstrate the devil is in the details. As I touched on in my opening remarks, close to 90 central banks are now actively considering plans to introduce a CBDC. On October 25, the Central Bank of Nigeria was the latest of which to launch a CBDC with its retail-based e-Naira for banked users. During the announcement, the central bank also outlined plans to extend the availability of the digital currency for unbanked users with access to a CBDC account via national identity registration. And in Europe, on December 8th, Europe's first cross-border trial of CBDC payments between Switzerland and France was described as a success by the Swiss National Bank and Banque de France. The trial, as part of Project Jura, was the first time a digital euro and Swiss franc were fully tested. It shows that it was possible to settle foreign exchange transactions in euro and Swiss franc wholesale CBDCs. The trials also confirmed the possibility for issuing, redeeming, and transferring tokenized euro-denominated French commercial paper between financial institutions. As you know, the one potential motivation for CBDCs is to smoothen cross-border payments. This type of trial will show how such an objective can be achieved, not only for individuals transferring funds across borders, but also for financial institutions and infrastructures to settle their transactions across jurisdictions. So, in conclusion, it is clear the CBDC conversation is advancing rapidly, but there remain many open questions about the implications of introducing a CBDC on the financial system, consumer behaviors, and, as you all know, the various policy design options central banks are considering. I'll now hand over to CBDC Broadcast first speaker, FNA's very own founder and CEO, Dr. Kimmo Soramäki, who, alongside our second speaker, Dr. Carlos León, will be discussing this very topic. Unless there are any sort of questions or comments at this stage that are relevant before we sort of get started, as I mentioned before, we will try and address all the questions in one go at the end of the session. I don't see any questions at this stage. So yeah, Kimmo, are you there?
Yeah, thank you. And great to be here. And hello, everyone. So today's topic is simulation. And I'll start with providing a little bit the background. Why do we do simulations on financial infrastructures, and how we then apply this in the CBDC space from the experience that we've gathered simulating various types of payment systems, financial infrastructures over the last decades. Before going there, maybe just a few words about FNA. So FNA is Financial Network Analytics. We are a technology company providing software and technology for financial institutions, regulators, supervisors, different types of commercial banks, other types of financial organizations, mostly around analyzing large data sets, large complex data sets, understanding the complex financial networks, and then being able to simulate them in order to understand the risks and opportunities, and how these systems work or should be designed, which I guess is the question today that we are asking. So how should a CBDC be designed, and how can simulations help with that? Do you want to go to the next slide? So I'll go through a short history of so where this payment simulation started from, and I think I saw Harry Leinonen in the audience today. So this was a work that actually Harry hired me to do in '97 to develop a payment system simulator for the Bank of Finland when Finland was joining the European Union, and the Finnish banks were interested in knowing what will happen to their intraday liquidity when this large change happens. So if that was a large change, introducing a CBDC into an economy is also a very large change. So we probably want to simulate it first before we execute and do it. So what I did there was to program a simulator. You see a nice Windows 3.1 graphical user interface there, which allowed us to do simulations on how this change would happen, and what would happen to the bank's liquidity and the payments. How would they flow outside of Finland into European banks and back? But also we started to do quite a lot of work on understanding how to make these large value systems better, bring different types of hybrid features from netting systems and RTGS systems, and we did quite a bit of research and published books and articles about this, which also then caught the interest of other central banks. And I was working, for example, with the New York Fed or the Bank of Japan to do similar types of simulations when this was a very new idea, and not very accepted initially. There were a lot of questions from the mainstream economists, like where's the equilibrium, and what are you optimizing here? While these simulations were more like what if scenarios. They were like, let's recreate the real system and the environment, see what happens when we do certain changes there. So a little bit different types of approach that maybe was more familiar back then. Of course, over the years, like these ideas have become more prevalent as we see when we go through the little history here. So if you go to the next slide. So after Bank of Finland, I started working at the European Central Bank, and one of the main sort of responsibilities I had was to participate in the regulatory approval process of CLS. So CLS is the continuous linked settlement system for foreign exchange, settling foreign exchange transactions or trades, and its largest infrastructure by value settled, several trillion US dollar equivalents each day. So this is also a large change to the FX market. So what the regulatory bodies, the ECB, the Bank of Japan, the New York Fed, and others who were there giving the regulatory approval to CLS was to ask CLS a lot of simulations. What happens, like if there's a market disruption, what happens if there's a failure of one of the CLS members, what happens under normal circumstances, how does the system work, what are the expected outcomes if different volumes translate to transition into CLS, and I was on the side of analyzing the simulations that were done by CLS. They had built a simulator to cover all these different scenarios, and I think it was the sort of the breakthrough for the idea that every large value payment system, every critical infrastructure, when it's introduced, like we need to do simulations. When we try to improve it or design new systems, we'll do simulations first, and that these simulations are now done by these infrastructures on an ongoing basis. Carlos is originally from the Central Bank of Colombia, and you did do simulations there on a daily basis of failing participants of the system and seeing what are the outcomes. So many large and even medium-sized infrastructures have this as an ongoing exercise. I think as a result of this CLS exercise almost 2 decades ago. Okay, so if we go to the next one. So then I think after the 9/11 terrorist attacks, another side of simulations got interest, which was we're not simulating in order to design it better or like seeing how a change affects, but understanding attacks on critical infrastructure. So this was the 9/11 terrorist attacks, which wiped out much of the physical infrastructure on Lower Manhattan, and I was a few years later at the New York Fed, and we were looking at the FedWire data and building simulations for attacks on critical infrastructure together with the national laboratories in the US. And some of like we have references to some of the papers that we published during that period. I think this is now even more important than it was back then. But now the attacks are not probably going to be physical, but they're going to be cyber attacks on critical infrastructures. And there's some work we do with some of the larger CCPs, for example, with the Chicago Mercantile Exchange on simulating the effects and how can we proactively protect the systems from different types of attacks. While this like maybe like a few decades ago, when something broke, when something didn't work, it was framed as operational risk, that there was a failure in an IT equipment. Now the first thought is that it's a cyber attack against, because there's a lot of state-sponsored capabilities that are being built to attack the critical infrastructures of your adversaries. Go to the next slide. Then a little bit later, so this was the first time that we started working with the Bank of England. We're also working currently in designing the next generation chaps together with them. But this was the FNA simulator was used to design the liquidity saving mechanisms for chaps. And we decided on a certain set of algorithms and a sequence of running those algorithms that is still in place today. And here we saw that the impact was that about £4 billion of collateral savings were brought to the banks from the introduction of the LSM. So quite a lot of savings from very small changes in the software. That, like these are large infrastructures. Small changes can have very large impacts downstream on a level of the economy. And if you go to the next slide. So currently we are actually working with quite a number of large commercial banks, because the same problem that the national payment systems have, it replicates on a group level for large global commercial banks to optimize and simulate how money moves and balance transfers are being affected within large commercial banks. Here we see some pictures that we created about the banking structures of a couple of different banks. So you see that some are very centralized and others are very dispersed with lots of parent subsidiary relationships. We created this from public datasets from the legal entity identifier level 2 data, just to show that these complex networks that these individual banking groups form also benefit a lot from optimizing their payment flows. And risks and capital that is tied together with those flows and credit lines that are being granted as part of the process. I'll go to the next one. But the latest one really that we are talking about today is taking these methods of simulation and work that research that we've been doing over the years together with the Bank of England and together with the national laboratories is to build a model, and we published that as a paper. On the left side, it's an agent-based simulation of central bank digital currencies. So we build an agent-based model of the in a way the economy, and then plugging in the central bank digital currency into that model and being able to run it in a simulator, in a graphical user interface, where we can run simulations and get insights about different aspects of how the CBDC is going to impact the banks, the monetary policy aspects of the central banks, or financial stability or payment system oversight, how it's going to affect the bank's balance sheets, profits from payment transactions for card companies, and so forth. So lots of different impacts of the CBDC, and what kind of parameterization of the CBDC results in different results for the economy and all the participants in it, to help aid this conversation and to be able to quantify some of these conversations. A lot of the conversation currently around CBDC is very qualitative. So what we're trying to do here is through simulations being able to quantify. And while you do these simulations, you actually have to define the system in nitty-gritty detail. So that helps us just go through all the issues that are coming up when we are thinking about how a CBDC should work for different stakeholders in that process, and aid them in quantifying and conversing this across different stakeholder groups. So I'll leave now to Carlos. Carlos will talk a little bit about the agent-based simulations and what that is, to get increased familiarity on that, and then what can the simulator be used for, and what kind of insights and useful questions you can answer with that. I'll now leave it to Carlos.
Thank you, Kimmo, and thank you everyone for being here. I'm sure that in this webinar and the forthcoming webinars, we're going to be sharing a lot of knowledge here. You and I mean all the participants, and we at FNA, we're going to share a lot of knowledge, and I think this will be very good and profitable for all of us who are interested in this CBDC deployment all around the world. So as Kim already said, and when he faced some problems when showing that simulation, it's a good tool to understand some problems, because typical economists think in terms of what is the equilibrium model of this, what is the econometric model behind this. The first thing that we want to address now is why a CBDC simulator. So next slide, please. The first thing is that a simulator model is very good to address uncertainties. And right now, as Kim already said, we have a lot of questions, we have a lot of concerns, we have a lot of uncertainties. We're sure that CBDCs are coming our way, but we don't know still which are the implications that we are going to face. So what we need right now is not an equilibrium model, is not an econometric model, because they're not flexible and they're not sophisticated enough to understand which are the outcomes that could arise when we decide some regimes or scenarios for the CBDC. So the main thing that we want to try to understand with these simulation models is try to address which is the impact from the technological, economical, financial, legal, and social viewpoints. That's the main thing. And if you think about it, there are many questions about money that arise when we are talking about the CBDC. Some of them are here in this slide. For instance, what changes in the payment behavior are we expecting under different types of CBDCs, regimes, or scenarios? Also, for given jurisdictions, what are the most likely outcomes of a CBDC? Because we already know that implementing a CBDC in Jamaica is not the same as implementing in France or in Finland, so on and so forth. So it's important to take into account all the differences across jurisdictions. Also, we would like to know which form of CBDC will be the most advantageous for users, merchants, banks, card issuers, and central banks, because all of them, they have different takes on what a CBDC should be doing and which are the aims that we're trying to conquer here. Also, one of the main questions that you can see qualitatively addressed is what is the impact of CBDCs on disintermediation under different CBDC regimes and scenarios. So it's very important for banks and all those financial institutions that are worried about what will be the impact of a CBDC in their business models. Also, the final question that we have here is under which regimes and scenarios will the CBDC endogenously replace cash or deposits? Because many people are asking themselves, well, is a CBDC going to complement or to replace cash? And all these questions are really valid, and it's very difficult to address them from a typical, let's say, methodology point of view. Next slide, please. So in this three-petal flower that we are showing you here, we have tried to summarize many of the themes or the concerns that many stakeholders around the world are having right now. And we classify those stakeholders in three different petals. The industry, which comprises banks, financial institutions, payment service providers, infrastructures, everything that has to do with the financial industry. In the middle, we have the central banks and financial authorities, and in the right petal, we have governments and other agencies. We can see that there are a lot of things that are common to these three petals. I mean, the privacy, financial inclusion, smart money, the change in the flow of data and information, cross-border payments, the role and the cost of cash, transactional efficiency are things that we all want to know from several point of views from all these three petals. But we have some themes or concerns that are rather exclusive. For instance, for central banks, and monetary sovereignty, monetary policy, financial stability, reputational risk. But we also have for governments and for industries some which are very particular to their functions. So it is important to take into account that there are many interrelated concerns from several stakeholders, and we're not including here like a big petal or the big flower, which is society as a whole, that are obviously concerned about what will be the outcome of deploying a CBDC. And as we normally say, devil is in the details, and so the design and implementation of the CBDC will impact these stakeholders in a different way and will conquer the aims of the CBDC in a different way. So next slide, please. Simulation is powerful enough to try to answer those concerns that we had in the previous slide, but also has the flexibility for us to include some other things that are already out there. CBDCs are coming our way. There are, as Will said at the beginning, there are several CBDCs already in place, but we already have cryptos and stable coins, which are in the ecosystem right now. The good thing about this simulation model that we're going to show you briefly is that with some twists, we can instead of simulating a CBDC, we can be simulating a crypto or a stable coin. It's just twisting a little bit the model, changing some of the features, perhaps the anonymity, perhaps how fast is the adoption by the consumers or by the merchants. But at the end, we are able to try to simulate the adoption of a digital version of the central bank's currency, but also the introduction of cryptos and stablecoins. So that's something very important in these kind of simulation models, the flexibility to do or to accommodate some different features or some different types of money, if you want to call them that like that. Next, please. So what I'm going to show you right now in the following slides has to do with what is right now the CBDC simulator solution that we have developed at FNA. Next, so the CBDC simulator is at the forefront of innovation in the fintech market because it's a software solution that enables central banks, government authorities, and other financial institutions to rapidly test, model, and simulate the economic and financial stability implications of introducing a central bank digital currency. It is very important for you to take into account that most of the models that are out there have to do with if it's possible to send money from user A to merchant C in a CBDC, or if it's possible for a government to send money through a CBDC to the users during a pandemic or something like that. It's more about the technical feasibility of the CBDC. What we want to do with this simulator software solution is to try to simulate the economic and financial implications of this. So the benefits of this simulation is that we would be able to test multiple policy inputs and specific CBDC models to understand the potential impacts on different financial system parameters. For instance, on the payment behavior of the people, the disintermediation, the growth of bank deposits, and ultimately financial stability. Obviously, if we take into account this type of economic outcomes, we would be able to quantify what is the impact in terms of financial inclusion. Will people really start using or having a mobile wallet with CBDC or not, depending on the parameters that we use in the model. So this will provide some clarity to the participants as to exactly how CBDC will affect their current business as usual payment processing and the choice of payment alternatives for the people. We would be able to simulate shocks and stresses to this new payment system and also to the existing payment system. So these simulations would provide the academic community, central banks, and commercial banks, and all the payments ecosystem with data, with synthetic data that would be very useful for taking decisions. And that's the whole point of this simulation type of model, to give the stakeholders an informed, to have a better decision process, just because you have more information of what are the outcomes, the possible outcomes that will result from different configurations, from different designs of the CBDC. Next, Will, thank you. So the model that we are using for this simulation is something which is called in literature as agent-based models. So it's a very interesting type of modeling, because what you try to model is a complex adaptive system in which different agents interact between or among them. And when they do that, they produce an emerging behavior that is not very easily simulated or reproduced with an equilibrium model. Also, because slight changes in initial conditions or the assumptions of the model may result in nonlinear changes in the outcome. So having these two elements of why would you use an agent-based models and why would you use simulation based on agent-based models, is because we want to try to cope with the complexity and the adaptiveness of the participants in the market. So at the end, what we're trying to have is a bunch of agents which are interacting among them and which interact while they're living or interacting in a given environment. And that environment is going to condition what their interactions and their behaviors are. Next slide. So this is the an let's call it like an easy way for us to understand what the model is doing. So top left, what we have is the central bank. The central bank conducts the monetary policy and issues the CBDC based on bank demand. Afterwards, the commercial bank, taking those CBDC which were issued by the central bank, will adjust their balance sheets and they will issue deposits at a given interest rate. And while doing that, the consumers will allocate their wealth among some risky assets and some payment instruments. Those payment instruments are cash, deposits, which are going to be used by the consumers with credit cards or debit cards. And also we are giving the consumers the opportunity to have CBDC wallets that they will top up from their bank deposits. So what we have is a bunch of large quantity of consumers that we are representing here, from consumer 1, 2 to consumer N, in which each one of these consumers have a different allocation of payment instruments. The first one has cash and a credit card. The second has cash and a CBDC card, which is the way we are representing CBDC here. And consumer N has 3 different payment instruments: cash, credit card, and CBDC card. To the right, we have the different merchants, which we have from merchant 1, 2 to merchant M, in which they have each one of these icons is representing which type of payment instrument are they willing to accept. So here we have a very interesting, and this is like the key part of the simulation, is we have here like a virtuous circle in which the consumers make purchases from the merchants depending on the accepted payment instruments, but the consumers' availability of CBDC increases the future acceptance of different payment instruments by the merchants, and also the merchants' acceptance of CBDC and the customers' adoption increases future availability. So there's a very interesting circularity, and this is something that we know in economics as a two-side market, in which the consumer will use the payment instruments if the merchant is willing to accept them, and the merchant is willing to accept them if the consumer have them available to pay with it. So this is exactly what the model tries to recreate: how consumers and merchants are making their decisions to top up CBDC wallets, to pay it with cash or to pay it with the deposits, and how the merchants are willing to accept those payment instruments depending on the consumer, and so on and so forth, in a very interesting circular manner. Next, Will, thank you. So the main model outputs that we will have to do with the adoption rate, which would be the base at which CBDC is acquired and used by the public, this is obviously a financial inclusion effect that everyone is willing to measure. We will also have something about the composition of the consumer's wealth. As I said before, they will allocate their wealth among assets, risky asset, cash, CBDC, and deposits on banks. So we will have like the evolution of this allocation along time. We will also have the diffusion of payment instruments. We will know the proportion of transactions that users are paying with cards, cash, or CBDC. We will also have some figures about the banking disintermediation, so the amount of bank deposits that have been migrated to CBDC after its introduction. Obviously, we will have the composition of the asset side and the liability side of the financial institutions, of banks, to try to understand how the balance sheet of these financial institutions is going to be affected. And finally, we'll have some outputs regarding how the monetary and the regulatory conduct about CBDC will impact the outcomes. And this is very important, as I said, because the simulator model is allowing you to twist the model a little bit, to change the parameters, and to see what are the outcomes in terms of adoption rate, composition of consumers' wealth, diffusion of payments instrument, and so on and so forth. That's the flexibility we want with the simulation model, in fact. Next, Will, thank you. So I'm going to show you here, and there was a question on the question and answers chat about which data are we using for the slide that Kimmo showed before about the simulator model. We're using some recent German data, and here we're going to show you perhaps the two main outcomes that we wanted to show you today. And it has to do with the ratio of CBDC to deposits and also to the value of purchases after the CBDC is introduced. Regarding the graph on the left, what we have is the total value of CBDC in circulation would be about 3% of the total deposits with the German data and the inputs that we used for the simulation. So what we have here is that from day 0, the day in which CBDC is introduced, we have a big spike in which a lot of people try to have top-ups of their CBDC wallets, and afterwards it goes down, and it starts like a normalizing process in which all the CBDC to deposits tend to be stable around or a little bit below the 3%. That's what we found with the German data. Also, with this German data, what we found about the value of purchases is obviously that the CBDC starting from 0 has a spike, and afterwards it starts to increase slowly and to find like a plateau in which these CBDC transactions stabilize. But obviously, there are like two affected, the two other payment instruments that we have here, cash and cards, which are representative of deposits. They will decrease a little bit. The most that the payment instrument that suffered the most a decrease was cash. Cards also had a slight decrease, but it was not as steep as the decrease in cash. And this is the type of answers that we want to see from a simulation model, in which to try to understand which are the outcomes that we will have depending on the parameters. Obviously, the parameters that we use with the German data have to do with the German economy and the parameters that we were able to estimate according to some historical data from Germany, which are very well explained in the paper that Kim already talked to you about. But if you change some of these parameters, obviously we will have a very different type of answer that we would like to try to analyze and to understand, to have a clear view of what are the outcomes of introducing a CBDC. It's not a matter of accuracy, it's a matter of having the tools for you to understand what are the different outcomes that you could have depending on how you design and how you deploy the CBDC. Next, Will, thank you. And that's what we had to do to say about the simulation model. So I'm going to go back to Kimmo.
All right, thanks. So I was thinking maybe a little bit maybe behind, but I can quickly show the little demo of the simulation. So if I can share the screen, Will.
Yes.
And if we can go into the questions that I asked, or if there are more.
There we go.
All right. Yeah. So it's a cloud. You should be able to see the screen, right? Do you?
Yes, we can.
And you have the right screen.
Nice.
That's my calendar. Yeah. So it's a cloud-based application. So it's running actually on Amazon Cloud, which allows us to do very large-scale simulations. So here I've set up a very small simulation. You see the simulator setup here on the left side. This is also an earlier version of the paper. So it's not as exhaustive on the parameters as what you will find in the paper. We are working now to put that paper's model into this user interface. But you get the idea that you're able to set up different settings around the agents, around the CBDC, like what is the maximum balance. I think there was a question on interest rates. We haven't got that implemented yet there, like on the remuneration of the CBDC, but that's on our roadmap. We've actually have got a relatively large roadmap of things. We've been conversing with maybe 20, 30 different commercial banks and industry bodies and central banks on what they would like, what are the questions that they have, so that we can then prioritize those questions in our work on further developing the model. There's behavior around the payments, like what instruments currently people are using, how are they topping up the wallets, and so forth. And then here, actually in this version, the adoption scenarios are exogenous. So we're just saying that over time, people will use a CBDC to make a large amount of small value payments in CBDC, and then seeing what is the impact on different variables. The question we really had in this first iteration was is it possible to set up a CBDC so that it doesn't disintermediate bank deposits to a large degree? And that's what we saw in the paper, that yes, with maximum balances set for the CBDC wallets of certain values, we can have CBDCs as a additional means of payment without reducing the bank deposits a lot. So here that's measured as the CBDC outstanding. So then we can visualize the results. Actually, I can just start simulating forward. So I have here now a simulation going on in the background. We are seeing the results in real time as the simulation moves. We see here the agents, the blue ones are merchants, some of them may be online merchants, some of them brick and mortar. We have consumers, we see who are they paying with different types of payment instruments. We can track and go look at individual consumers, what are they doing, the distribution of purchases, what kind of value purchases they end up doing. And here we see the total value of outstanding CBDC in this little economy of ours. And we can stop the simulation. And so we see the CBDC outstanding is about 28,000, but we could say that, and that is because we've capped the CBDC maximum balance that people can hold on their wallets to 500 units. These are euros, but we could set up this to 1,000 euros and start the simulation again and see what would be the impact of this policy change on the different parameters in the simulation model. First of all, the outstanding amount of CBDC, because people can now hold more CBDC on their accounts. We don't know exactly how much they would hold, because that depends on the behaviors for their top-ups that we've set up for the agents. Who are they purchasing what, when, using which payment instrument? But we see on the system level, the emerging behavior is that the outstanding CBDC would over double if we at least initially before people started to top up more before they now use some of it, and then they get over time it goes into some equilibrium that is probably higher than the equilibrium which we had when we had only 500 as the limit. So this is just one example of sort of one parameter change, very simple parameter change that we can start to converse about when we run this model, but of course all the data that is generated at the back of this around the different outputs that Carlos described is also available for download and further analysis. But I think having a user interface like this makes this more lively and the conversations more easy when you're trying to explain what is going to happen in an economy when you introduce a CBDC. Alrighty, hopefully that was interesting. I'll stop sharing my screen and maybe we can go back to the questions that we had in the Q&A.
Yes, thank you very much, Kimmo. I'll just share my screen again. Yes, we've had several questions. So in the interest of time, I know we're closely approaching the 1 hour mark. I'll just get through some of these. So how flexible is the model to assess other scenarios or design choices, e.g. direct models or non-DLT options?
The model, like Carlos said, is modular, so we can add new aspects to it. The current model that we have is geared towards having an indirect model, where the CBDC is issued through the banks in a way like cash is issued today. So we took sort of like the cash model and plugged it into the CBDC model. So we would need a little bit changes to the model in order to do that. But the thinking that we had in developing this model is that there's huge amounts of different questions around CBDC. It's very expensive to develop these agent-based models from scratch. is that we can use always the framework and the software and the visualization and the engine that we've developed as a base, and then expanded together with different institutions in projects into different directions. So the intention is that it is easy to do that rather than very difficult. I added the paper into the chat. Someone asked about it as the last question there.
Thank you very much, Natalie Thomas, for that excellent question, and Kimmo for your answer. We have another question from Mirko regarding the CBDC models fit to the sort of crypto and stablecoin sort of market entry scenarios. So Mirko is not entirely following the logic behind the possibility to sort of easily adapt the CBDC model to these markets, as the two sets of as the two sort of systems have different and numerous dimensions. Could you please expand on this?
I think I'll take that one. The thing, I agree with Mirko that they're very different kind of animals. The thing is that with this type of model, as Kimmo said, that is modular, we're able to fit some different features of CBDC and to introduce some other type of, let's call them currencies, as a stable coin or a crypto, in the sense that we can just, I'm saying just, change the rules that individuals are going to follow and the merchants are going to follow, just to take into account that there are different kind of let's call them currencies once again. For instance, what Mirko said, some are private, some are public, some are centralized, the others are decentralized. The thing is that by changing the rules, by changing the parameters, we're able to try to fit some other digital currencies different from a CBDC. We could also include some parameters as is CBDCs is completely anonymous or not, that will affect our simulation. Also, if we know that if we're going to model something as a stable coin or a Bitcoin, which is pseudo-anonymous, we can put an input, we can design an input that will take into account that kind of feature and try to see what are the outcomes. So what we're not saying is that exactly the same, it's not exactly the same model, that we will be able to come with a different model, some different parameters to try to accommodate those different kind of, let's call them once again, currencies.
Thank you very much, Carlos, and thank you, Mirko, for the interesting question. Moving on, we have a question from Massimo. How would it be possible to avoid the potential bank disintermediation, i.e. the possible shift from deposits to CBDCs?
Yeah, I can take that one. I think that's also Stephen answers that also there in the chat. So yeah, that is by different caps on the balances, caps on the transaction values. There's I think the interest rate is one, but I'm not sure actually how effective that is. I'm paying negative interest rates from some euro balances that the company holds already. It's not a large enough cost to care. Yeah, so those are the things that you can try here. And see the impact. I think there's another question related, or how would the system look like if we would completely remove the balance limit? So there would be a certain amount of balances that they would hold that would just come from the transaction demand. So we could do that. It would not like balloon forever. They would just hold according to the rules of the game, where they withdraw CBDC to cover for 10 days spend. And then use those monies and then top up again. But there's lots of different top up rules that you could think of, and in recent days have been discussing with some people the immediate top ups, so that maybe the CBDC wallet gets topped up on demand when you need to actually pay something. For larger value payments. For smaller value payments, maybe you hold a smaller balance. So they're more complex rules that depends how the wallet software works. And we can then model different ways that the wallet software would work and see how beneficial they are for different parties or not. Yeah, so I think the thing here is that the CBDCs can be configured in so many different ways. And we need to be clear about like what is the model that we are talking about, so that we can actually implement it into the simulation and then run it through and see sort of what would happen with that. And maybe different stakeholders would prefer different parameterizations. Maybe there's a different parameterization that is better for everyone than the one maybe currently discussed. And with the simulations, what we want to try to do is move from qualitative discussions to quantitative discussion. What is the impact? Like how much more money like would be held if the balance cap was removed in the economy? How much money are we talking about? Is it billions, 100 billions, more, less? You know, like what is the magnitude of it? It's hard to say outright before doing this type of analysis.
Brilliant. Thank you very much, Kimmo. We have a couple of questions from Richard Pattinson. The first of which, assuming constant money supply, do we presume that for every 1 unit of CBDC issued, then the 1 unit of fiat money is retired?
Yeah, in the current model, yes, we do that. So you buy the CBDC from the deposits, and the banks buy CBDC from the central banks by transferring them central bank money in the RTGS system. So in the way that the cash works currently, so it's a pull from consumers how much they want to hold, and then the banks fulfill that by purchasing or borrowing, I don't know, like enough from the central bank.
Brilliant, thank you. So we have a couple more minutes. We do have lots of questions to go through, so we'll probably have time for a couple more. But you know, the questions that we don't go through, we'll make sure that we follow up with you following the session, and please feel free to contact us via the emails on the slides and stuff if we don't reach your question. But just in the interest of time, we've got a couple more.
There's one question from Zbigniew, who is an old colleague of mine from the ECB, I think, asking how many CBDCs can be awaited in the next 10 years. I think many. I think over the last year, I've become quite convinced that the CBDCs are coming faster than anyone thinks. Anyway, the train has now left the station and it's steaming fast forward. And that there are so many different reasons. I think the stars are aligned in many directions, from what is happening in the crypto space to like a new thinking around monetary policy, around sovereignty, around national security concerns, around loads of different like macro things, and then also demand from the consumers, especially in emerging markets, through the COVID lockdowns and the unbanked. There's a question on unbanked actually there. So that could be parameterized in the model by only having, for example, access to cash. So that would be a person that would be unbanked. They wouldn't have access to credit cards or deposits or others. So that would be a parameterization of the model. And we could then see sort of like how these unbanked can use a CBDC or start using CBDC for online transactions, for example. I think that's one of the sort of like use cases we've thought through with the model. But yeah, so I think and we don't know yet. We don't understand the CBDCs sufficiently yet because we haven't dig into the details of how everything will work. That is sort of the work that we're doing with this simulator, because it forces us to dig into the details, because otherwise the software won't run.
I think at that one point, very important for that discussion of how many CBDCs are we going to see in the forthcoming years. I think perhaps the most important question is why. And this why question differs on each country and each region. So I think that perhaps some of them will come very quickly because they're trying to tackle something very specific in the short term, but perhaps some others are going to come slowly as time goes by, and different examples come out and serve as an example for other countries. So I think it will depend a lot on what our countries or central banks pursuing with CBDCs. It will depend a lot on that. I mean, the speed and the type of countries or regions that will deploy the CBDC will depend on that a lot, I think.
Thank you very much, Carlos and Kimmo. And thank you very much, everyone, for your questions. We're inundated with questions, but unfortunately, we're just slightly over time now. So we're taking note of each question, and we'll make sure to follow up on these questions in our sort of follow up message tomorrow, where we'll send you the recording and the presentation deck for your reference. So with that said, I think we're ready to conclude today's session. So thank you very much for your participation and your questions today. And thank you, Carlos and Kimmo, for your fascinating presentations. On the slide, I have a few sort of final points to mention. Once we send around the slide deck, please feel free to take a further look at FNA's CBDC research paper, which Carlos and Kimmo have spoken a lot about today. If you have any questions or comments, again, would like to arrange a demonstration of FNA's CBD simulator, please feel free to reach out to myself or Carlos, and we can set that up for you. And as I think Anthony has been addressing in the box just now, we'll be following up today's session with the slide decks and recordings, and in the coming days and weeks, you should all receive an invitation for the second session of the CBDC broadcast to be hosted in February next month. So we're looking forward to seeing you all again there, and hopefully we'll get as many questions as we have done today, because it's fantastic to see that the content that we've prepared has been interesting and thought-provoking. So thank you very much, everyone. And we'll see you next month.